Welcome to The Explainer. Today we're talking about Deckers, the company behind those unstoppable Hoka running shoes and the classic UGG boots. They've just dropped their latest numbers, and we're going to break down exactly what's going on with the business.
Now, we're going to skip all the high-level corporate talk and get straight to the good stuff, the numbers. For this explainer, we're focusing only on what the Chief Financial Officer said. This gives you a raw, direct look at the company's performance and, more importantly, what they think is coming right around the corner.
So here's the game plan. We'll start with the big results for the third quarter, then we'll dig into how Hoka and UGG are really driving things. After that, we'll get into the profit story, check on the company's financial health, and wrap up with what Deckers is forecasting for the year. All right, let's get into it.
First up, let's look at the top-line performance. How did Deckers actually do in its third quarter of fiscal year 2025? Let's jump right into the big numbers.
Deckers pulled in a whopping $1.43 billion in total revenue. That's a really solid 9% jump compared to this time last year, which shows you the company's momentum is still very much alive and well.
So you might be asking, where is all that growth coming from? Well, a huge piece of the puzzle is Hoka. The brand just continued its incredible run, with revenue jumping another 11%. It's pretty clear that demand for their unique running shoes is not slowing down one bit.
And hey, not to be outdone, the UGG brand also put up some really strong numbers. Revenue was up 10% for the quarter. A lot of this was them getting their retail partners all stocked up for the peak holiday selling season. Now, all that strong sales growth flowed right down to the bottom line. Diluted earnings per share, which is just a fancy way of saying the company's profit for each share of its stock, grew by a very, very healthy 14%.
So, those are the big headline numbers. But what's really fascinating is when you start to look under the hood. You see, Hoka and UGG were both super successful this quarter, but they got there taking two completely different roads.
And right here, you can see two totally different stories playing out. Hoka's growth was pretty balanced. You had wholesale sales to retailers up, and their own direct-to-consumer sales, or DTC, were also up. But now look at UGG, a massive 17% jump in sales to retailers, but a 10% drop in sales from its own website. So what gives? Well, the CFO explained that they basically shipped products to their retail partners earlier than usual to meet huge demand. That move essentially shifted sales away from their own online store over to their partners' stores.
Okay, so how did all of this affect the company's actual profitability? This is where we uncover a really interesting detail, something about timing, and a pretty big challenge that's waiting just ahead.
To really get this next part, we've got to quickly talk about gross margin. Just think of it like this. It's the profit the company makes on each and every product it sells, before you account for all the other business expenses, like marketing. A higher number here is always better.
Deckers posted a gross margin of 56.2%. That is incredibly strong, and it's even up a little bit from last year. Now, this was helped by a few things, like some price increases and favorable currency rates, but there is definitely more to this story.
So it turns out this really strong margin number got a temporary and you could almost say an artificial boost. See, Deckers raised its prices back in July, but the financial hit from new tariffs on its products hadn't really kicked in yet. The CFO was super clear about this. It was a unique timing fluke just for Q3. It basically created a calm before the storm. And believe me, that tariff storm is coming.
Of course, you know the old saying, you gotta spend money to make money. To get that kind of growth, the company boosted its spending on things like marketing and R&D by 11%, up to $477 million. It's a clear signal they're still investing heavily in their brands for the future.
So, with that performance in the books, let's do a quick financial health check. How does the company's balance sheet look at the end of the quarter?
The takeaway here, the company is in a fantastic position. It finished the quarter with $1.4 billion in cash, absolutely zero debt, you'll love to see that, and inventory levels that are only up 7%, which is a really manageable number. Oh, and they also spent $282 million buying back their own stock. That's a huge sign of confidence in their own business.
And all of this brings us to what's arguably the most important part of any of these financial reports, the forecast. What does the company actually expect for the full year? After that really strong performance, Deckers has gone ahead and updated its official outlook for the rest of fiscal 2025. So let's take a look at what they're expecting.
Okay, here it is, the official forecast. They're projecting about $5.35 billion in total revenue for the year, and they expect to keep that really strong 56% gross margin. And check out the operating margin, a top-tier 21.5%. All of that leads to an expected earnings per share somewhere between $6.30 and $6.39.
And here is where that whole tariff story comes right back into focus. The CFO was explicit. They are expecting a total negative hit of about $150 million from tariffs this fiscal year. Now, they think they can offset a good chunk of that, somewhere between 75 and 95 million, but that's still a massive headwind that's going to become very real in the second half of the year.
Which really leaves us with the big question for Deckers, doesn't it? I mean, the company is performing incredibly well. They've got two of the hottest brands in footwear, period. But as we've heard directly from the CFO's own numbers, there's a major challenge on the horizon. The next 6 months are going to be a real test of whether their disciplined model can navigate that storm and protect their best-in-class profitability.